Hello and welcome to another Macro Monday. My name's James Brodie and we have a busy week ahead, but we'll also be discussing Nvidia and Gamestop's back in the news again. Firstly, let's look at what happened last week. The week started with some broad risk aversion as we had particularly weak auctions in the US. The 2-year, the 5-year and the 7-year auctions all went particularly badly, with long tails over 1 basis point, and we saw equities start to fall off the back of that. With respect to the economic data last week, it started the week slightly better with a strong consumer confidence coming in at 102 when just 96 was expected. But then we had very weak US pending home sales. Month on month falling 7.7%, expected to fall just 1%, and this made the market fairly nervous. GDP came in, second round GDP for Q1 came in at 1.3%, revised down from 1.6%. So the economy is still growing, but the growth is being revised lower. Then we came to Friday. The key data was PCE inflation data. It came in as expected, 0.3 month on month, up 2.7% year on year, and the market started to wind down for the weekend. But then suddenly, 3 o'clock in the UK, secondary data hit the wires and suddenly everyone paid attention. Chicago Purchasing Manager Index, a regional index, dropped to outright recessionary levels. Expected to come in at 41.6, it slumped to 35.4. This was the third lowest reading in 40 years, only lower in the financial crisis and during COVID. As you can see from the chart, and every time Chicago PMI has been at these levels, the US economy has been in recession. This is one reason why I think there is no chance the Federal Reserve will hike rates again. The next move will be a cut, and this week's data, employment data on Friday, will be the key. We'll come to that a bit later. Some data out of China at the end of the week. China factory activity unexpectedly dipped. China manufacturing PMI for May fell to 49.5 from 50.5. It fell back into contraction. Even the non-manufacturing PMIs came in below expectations at 51.1, below the 51.5. And in Euro area, we saw weaker consumer spending and retail sales in both France and Germany. That's key. This week, we have the ECB meeting on the 6th of June. The market's fully expecting the ECB to cut 25 basis points this week. The market will be focused on what ECB Governor Christine Lagarde says in her statement. ECB member Villeroy came out last week and said shouldn't exclude a second rate cut in July. Central banks are cutting rates, and in fact, the day before the ECB, we have the Bank of Canada, and the market is expecting a cut from them this Wednesday as well. The OAS is pricing 21 basis points, so the market is virtually fully expecting a cut from both the Bank of Canada and the ECB this week. In the UK, we had some data last week. Shop prices rose just 0.56% year on year. And the IMF came out and said that UK interest rates should be cut to 3.5% by the end of next year. What I find incredible is that the OAS is pricing more cuts from the Fed than the Bank of England this year. In the UK, there's only 34 basis points of cuts priced by the OAS, by the Bank of England this year. But we have inflation at 2.4% and heading rapidly lower. Cumulative growth in the past 12 months is 0.8%. Home prices in real terms are 12% off their peak, and total employment is contracting 0.7% year on year. To me, with the ECB and Bank of Canada cutting, I'm pretty certain the Bank of England will be cutting soon, and it will be cutting far more than the 34 basis points that's priced. Expect UK CPI to fall aggressively in the months ahead. I saw Hong Kong retail sales as well, a shocking number. Forecast to fall 6.3%, actually came in 14.7% year on year. So we're seeing far weaker retail sales from Hong Kong. Yep, that's a pretty small economy globally, but it just adds to what we've seen last week out of France, Germany, and previously out of the UK and the US as well. The consumer is certainly hurting. And in the US, it's the fiscal policy that's keeping the economy going, but the consumer's hurting and the central banks need to cut more urgently. OAS pricing by year end, the Fed just 35 basis points of cuts priced. Remember that start of the year, it was 175 basis points. Again, if we see some weaker payroll data on Friday, it's a big if, but if we do, we'll see that sharply repriced. ECB, a cut this week, including that cut, the market's expecting 59 basis points of cuts this year, just 34 from the Bank of England. Again, in my view, that is a mispricing. The market will reprice that shortly. And Bank of Canada, 21 basis points of cuts this week, total of 61 this year. And the Bank of Japan, of course, the market's expecting another hike there. On to equities. We saw some pretty big outflows last week. Japanese stock funds suffered their biggest weekly outflow on record at $5.9 billion equivalent. And in the US, hedge fund outflows were the largest since January. Nvidia, interestingly, over the long bank holiday weekend, gained 5% on no news whatsoever. Gained 5% in the long weekend overnight trading session. And this brings up an old but simple trading strategy to buy on the close and sell on the open. If you can see from the chart here how that would performed with the S&P, if you bought on the close and sold on the open, that would have massively outperformed buying on the open and selling on the close. And while I say that, Monday morning, we have Gamestop up 85% after hours in the overnight trading session. And what we have there, Keith Gill, better known as Roaring Kitty, came out on Sunday night on his social media account and revealed that he owns $115.7 million of GameStop equity. Again, it's up 85% after hours. I certainly wouldn't be buying that. Simple game theory. If you're long, the market's jumped on a move like that, you should be taking profit. If you're not in, don't have a position, that would be one to stand aside. I fear retail traders will be drawn into that and their losses will be fairly catastrophic afterwards. Onto the S&P. Breadth is now the worst it's been since 2009. If we look at the S&P 500 relative to equal weighting, you can see that the market is being driven by the big five. In fact, Nvidia is now 40% of the S&P growth this year. The market's being driven by a few key names. And in fact, if you're long an S&P ETF, then you're effectively long Nvidia. The Nasdaq, interesting price movement on Friday. Key support here, just over 18,400. You can see it's the previous high. The market tried to break below it on Friday, and in the last 20 minutes, we saw aggressive buying. S&P forward earnings are now have fallen relative to the 10-year bond yield. They're now at the same level. In my view, equities are expensive at this level. I wouldn't be short, but if the Nasdaq closed below 18,414, then I would take a short with a stop loss above that. Again, a lot of the equity market is driven by Nvidia. What's interesting here is we've had two gaps in the last 2 weeks. Key support, firstly, is at 1,064. You can see the higher white line there. That was the base of last week's gap. The market on Friday sold off down to that level and bounced into the close. Again, a close below 1,064. You will see some funds taking profit. And then a close below 958, which is the low of the previous gap. Multi-highs from February through till May. A close below there, you will see an aggressive move lower. Nvidia, again, the moving average, the momentum is still higher. I certainly wouldn't be adding at these levels. If I was long, I would take profit below 1,064. And I fear below 958, you'll get an aggressive move lower. Markets don't move in one direction. They have retracements. The market is very long of this stock. Expect volatility. I mentioned earlier, property, US pending home sales fell month on month 7.7%. The key with house prices in the US, people effectively cannot afford to move. House prices are so high and mortgage rates are so high. House prices tumble, sadly, when unemployment goes up. And that's why, again, Friday's payroll data becomes so big. If we look at China's housing market, last week, China's Shandong province has lowered the minimum down payment ratio for personal housing loans and removed the lower limit on loan interest rates. The China property market has been declining now for 3 years, and they're doing more and more attempts to stimulate that market. Housing is very specific to each country. If you look at Japan, there are over 9 million empty properties in Japan. They have demographic issue and also a reluctance to lift their extreme immigration policies. If we look at Germany as well, Germany was a country that people rented as opposed to buying up until the financial crisis. After that, we saw far more aggressive home ownership. But now, with mortgage rates so high and the faltering economy, this has caused a significant increase in insolvency-related transactions. Again, property is unique to each country. Of course, Australia and UK, for instance, we have extreme housing shortages. Back to some charts. Here's a chart of year-to-date performance, and you can see how commodities have clearly outperformed equities and other markets. With the risk aversion last week, towards the end of the week, actually we started to see a retracement in some of the commodity metals which had been so strong year-to-date. Silver, notably, has pulled back, and right now it's trading at 30.1, which was the key breakout level. That should act as support, but again, the market has been aggressive buyers of gold and silver, and we'll see if that support can hold. Gold, hedge funds have boosted their bullish wages in gold to 4-year highs. Again, that makes pullbacks critical. Can the market support hold? If it breaks, then these long positions are forced to liquidate. On to chart of the week. Last week, I highlighted shorting sterling against the US dollar. That is currently trading 50 ticks lower. This week, back to sterling, but I'm looking at sterling yen here. Shorting that, currently trading at 199.5. It's trading quite aggressively lower today, but you can see there is multiple tops at around 200.65. So I'll short here with a stop above 200.8. And what you're trading here, multiple things taking place here. Firstly, a belief that the sterling UK interest rates will move lower. Secondly, the interest rate differentials between the two countries will narrow. I believe that will take place. And also, I think the extreme trade against the yen has now gone too far. I do not believe there's a yen currency crisis. I believe it's an interest rate play, which makes this an attractive trade because you have a stop that's close by. If the UK are forced to cut rates more aggressively, well, this has traded down at, during the COVID lows, down below 120. You have a tight stop loss. The first target would be first support around 191. So my trade recommendation for the week is shorting sterling yen at these levels with a stop just above 200.8. On to the data this week. A really busy week. Today we have US ISM. Tuesday, JOLTS, job openings data. Wednesday, a big day, Bank of Canada, markets expecting them to cut 25 basis points. US services PMI and Australian GDP. On Thursday, we have the ECB expected to cut 25 basis points. The focus is what they say after that, how they lead the market. And then the big one on Friday, US payrolls. That has the opportunity to deliver a big impact on the market and reprice bonds and OIS curves significantly. We also have the Nvidia 10-to-1 stock split, but again, with volatility so low, the VIX, the MOVE index, I'm expecting a volatile week and all eyes on Friday's payroll. Have a great week. Thank you very much.